Bitcoin has just closed a weekly candle underneath the 200-day moving average. In today's video, we're going to be discussing what exactly this means, the 4-year cycle, and how the macro charts are shaping up from a technical and structural perspective. Let's go ahead and dive into it. What's going on, guys? Welcome back to the channel. I hope you're all having a fantastic day today. We're here to take a look at Bitcoin on the higher time frames, on the monthly chart and on the weekly chart, discussing it from a technical and structural perspective, talking about the 4-year cycle, the 200-day moving average breakdown and close, as well as the possibility for new lows and everything in between. Before we get into it, smash the like button, hit the comment button, and subscribe to the channel. We do daily videos for Bitcoin, focusing on the facts, the data, the technical and structural information, the economy, and the news events. No hype, no BS, no emotion, pure raw TA. If that is the kind of content you like and are interested in, you can join us on Telegram. That will be the second link down below. You'll get access to our charts, our updates, our analysis, our educational posts, our news events, and everything in between to keep you in the loop with not only cryptocurrency, but Bitcoin and the economy as a whole. If you're interested in joining our VIP channel, where we post the trading signals with exact entries, exact targets, exact stop losses, such example over here, entries, targets, stop losses, every trade comes with clear justification and trading setups as per the charts. You can find more information about that in the free channel. Go up to the top, click the pinned comments, and you'll get more information. Including getting access to our VIP channel, you'll get access to our group chats where we have all of our members talking, discussing trading, and even taking their own trades as well. More information can be found. Let's dive into the video, starting off the market data. And today is going to be a big day, guys. We do have CPI coming out very shortly, within about 10 hours from now, I believe, a little bit under 10 hours. We have PPI tomorrow, and we have the interest rate hike decision the following day. So a very busy week, a very intense week, and a very important week in determining the higher time frame direction for Bitcoin. We'll be discussing a lot of that in today's video. Currently, for the 24-hour period, we can see Bitcoin is sitting at $56 billion in 24-hour volume. We're looking at about 9%, close to 10% up for the last 24 hours. Moving on to liquidations, we can see we're sitting at $52 million in liquidations, down around 3%. Again, not too much movement going on in the cryptocurrency markets in the last 72 hours. We're more or less pushing sideways ever since we saw that collapse toward the downside. June is currently sitting just under 4, around 4.59% in the red. Again, we're halfway through the month. We're coming up close halfway through a month, not making any decisions yet on that at the moment. But if we do look at the monthly candle, we'll go off the monthly candle alone. We can see June was expected to be red, and we'll expect to be red as we did have that bearish candle close, right? This candle over here, the red candle, is a bearish engulfing candle, meaning the closing price was below the opening price of the prior candle. This usually isn't significant, but in the instance where we see a bearish engulfing candle after a large move toward the upside, it can represent a shift in strength, a shift in momentum, and a shift in overall direction. So we are keeping our eyes on that. It doesn't necessarily mean we're going to get a macro reversal toward the downside, but it definitely suggests we are starting to see weakness. We're seeing that weakness develop. We're seeing momentum flick negative. And as a result of that monthly chart, weakness, we have seen, in fact, a daily trend be bearish now for quite some time. We're in a downward trend on a daily for about 2 months now, pushing downwards. And until we break above that line, until we flip the daily trend bullish, we do have to assume the possibility to go lower is still there. Again, all of this will be discussed in today's video. Moving on to volatility, we can see the 30-day volatility index. We saw a little bit of a jump up in the 30-day volatility index, and again, that's kind of expected as we see a lot more volatility move into the market. Get these large swings, big liquidations, volatility will obviously rise. Same goes to the 60-day volatility index. We saw a lot of compression on the volatility index over here. We saw about 15 to 20 days of compression, followed by an explosive move upwards in our volatility, signifying again a large amount of liquidations and a strong move in Bitcoin's price action. Moving on to our liquidations, we can see with 53 million liquidations, we're looking at an even split of 28 to 24 million from shorts and longs, very much even. And if we look at the exchange liquidations, we can see, again, we're sitting quite evenly over the 24-hour period. In the last 4 hours, a lot more of these shorts are being liquidated. And I've said already, guys, I'll say it again, if you're taking late shorts right over here, you're doing the wrong thing. you really are doing the wrong thing. If you look at our channel, if you look at the trades we've been posting in VIP, if you're in the VIP channel, you would know we were loading shorts. Look at all your short profits right over here, hundreds and hundreds of percents from short profits in the last few weeks. ADA 100, 200%, Bitcoin 200%, Ethereum 80%, ADA 200%, AAVE 180%, ICP 165%. The list goes on. But if you're taking late shorts now at support, at this critical level, you are doing it wrong, particularly with news events coming out very soon. And a lot of these late shorts are probably going to get liquidated on a scam move upwards as per news events, or if the price does actually just push upwards, they're going to be chopped out of the market. So definitely keep your eyes on that. Wait for confirmation of moves, wait for directions before you jump into the market. Remember, if you're looking for shorts, you want to trade into weakness. If you're looking for longs, you want to trade into strength. You don't wait, you don't play a 50-50 coin flip. We're not gamblers here, we're traders. We wait for the probabilities to line up in our favor before we make action. If the probabilities are not in our favor or the market is indecisive, you hold off. You wait a little bit, maybe you put a little bit more money in, you be patient for the moves to fall into your lap. If you're chasing the market, if you're chasing trades, if you're desperately trying to find things to do, you're gonna get wrecked essentially. Moving on to the DXY, we can see the DXY is still respecting its overall uptrend. We can see it represented by this uptrending support line over here. Again, we don't expect the DXY to correct unless this trend line is broken. Today's going to be a very important day in determining whether this trend line will hold or will break, as we do have CPI coming out very soon. We have PPI tomorrow, and we have, of course, interest rates the following day. So, of course, if any of these signify the market is recovering, the economy is recovering, that would represent falling inflation, okay? That would most likely push down the DXY. Now, if the DXY does lose its uptrending line, that is going to be incredibly bullish for the broader markets. It'll be bullish for the stock market, it'll be bullish for cryptocurrency. We will see the markets rally. If that does happen, we can expect to see the DXY potentially fall as low as 101.5 to this low 100 range. If the market does actually give us a negative result, meaning inflation is back on the rise, we could see a positive result for the DXY, resulting in the DXY rising upwards. Now, why does the DXY rise upwards when the CPI, when inflation data shows that it's rising? Well, inflation data is rising. That is a leading indicator for interest rates. And of course, if we know interest rates rise, the cost of debt rises, the dollar gains value. Moving up to this flow chart really quickly, we're not going to spend too much time on today. We can see CPI and PPI are leading pieces of information for what inflation is doing. They're descriptive and leading. PPI is leading as the producer price index goes up, the cost for producers rise, the margins need to stay the same for profit, and those extra costs get pushed onto consumers. So CPI is a reflection of overall inflation rate. If we start to see the month-on-month inflation rise, that is a good indication that interest rates are either not doing enough or are too low to negate the rising inflation. And therefore, interest rates are more likely, this is the key word, they're more likely to rise in this period or the next period, resulting in an unfavorable condition for risk assets and the debt service ratio going up as a result of the cost of debt rising. This, of course, has a ripple effect on absolutely everything else, but one of the main effects is it results in the dollar gaining strength, and that pushes the DXY upwards. So DXY, the general representation of the strength of the dollar. I say a general representation because it's not an exact representation, it is a general representation of. We're not going to get into that too much today anyway. So moving on from there, guys, let's take a look at the economic data. We do have CPI coming out very soon. The key one I'll be looking at is month-on-month inflation. I'm not too concerned on year-on-year inflation. The reason being is because we already know last year's time inflation was rising quite rapidly, and right now inflation isn't rising rapidly, and therefore it is quite logical to assume that if we take a year-to-year forecast and we delete the prior or the earlier months of account where inflation was rapidly moving, there was a large volatility, and we start deleting those periods of large volatility, it is reasonable to assume that the overall year-on-year inflation rate will actually start to decrease even if the monthly inflation rate is increasing. So the key one I'm looking at is the monthly inflation rate. At the moment, it is forecasted to be around 0.3, and this is still negative, right? This is a plus 0.3, indicating inflation is still rising. Last time it was 0.4. What we would expect to see? If we get 0.4 or above, this is going to be very bearish. This is going to be very bearish on the markets. It's going to set a bearish tone moving forward into interest rate hike, and could potentially shift the probabilities into a 25 or even a 50 hike. So if it is 0.4 high, I do expect the markets to react poorly. If we do see 0.3 to 0.3 to 0.4, so we're looking at 0.3, I think the market is going to react quite volatile. I don't think it's going to be too decisive. And I think the decision is going to be pushed onto PPI and potentially interest rates, meaning I don't think we'll see anything more than volatility and then sideways chop for another 2 days. If we get under 0.3, that is going to be a bullish sign. That'll be a sign that inflation is actually falling back down. It was a sign that this rise last month was nothing more than a single month jump up in inflation as a result of bailing out the banks, and now that has been over, now inflation is coming back down. That will be a very bullish sign. So under 0.3, bullish. 0.4 and above, bearish. 0.3 itself, kind of here and there, have to push it down for a few days to wait and see what happens. Looking at PPI, we'll come back to that in another day, but of course, very similar results here, and we're looking at the same kind of forecast. And as for interest rates, it's very clear. If we do get a pause in rates, which is currently what is expected, that is going to be very bullish to the markets, although in the long term, it is going to be bearish, because if we do get a pause and inflation is still rising, that only kicks the can down the road, meaning at some point, they're going to have to lift up these interest rates again and more aggressively. So the best possible decision they can do right now is to keep 0.25. It kind of puts them in a middle ground. It puts them on the fence, saying we can tip one way and we can tip the other way depending on what the market does, depending on what inflation does. If they commit to going to a pause, they're almost putting all their eggs in one basket. They commit to going to 0.5, again, they're putting all eggs in one basket. So I expect, regardless of what happens to inflation, I expect this month to be 0.25. Looking at the broader markets, the S&P 500 has on a moon mission, of course, breaking above its major resistance. The next key point of resistance is going to be this uptrending trend line. Look for a move towards that level before a possible rejection. Again, uptrending support level is intact. Therefore, the uptrend is assumed to be continuing upwards until this uptrending support is lost. If we ever get a weekly candle below this uptrend, that is when you know the uptrend has been lost and the price will correct. Same goes for the Dow Jones. Let's go ahead and get into Bitcoin, because we did spend a lot of time on that already, but it's very important because today is an important day with a lot of news events. We have to understand what is going on. So in today's video, we're going to be discussing the macro charts, the 4-year cycle, and the 200 moving average, as well as the weekly charts, and really briefly going over the daily. So let's go ahead and get the daily stuff out of the way to start off with. I wanted to briefly interrupt today's video to discuss my favorite exchange, BitGet. If you're looking for a safe, honest, reliable, and accurate exchange, look no further than BitGet. You can sign up by the link in the description to support the channel and get access to 3 exclusive perks. That being up to $5,005 in trading rewards, up to 15% discount on your trading fees, and exclusive access to our MegaWhale promotion campaigns that we run every few months. Alongside that, guys, BitGet is a non-KYC exchange, meaning you do not have to KYC. It is completely optional. BitGet also has a protection fund that secures user assets against external hacks and threats in the space. Alongside that, guys, BitGet offers up to 125x leverage on futures with extensive amount of trading pairs and liquidity on the market. I highly recommend signing up to BitGet. It is the exchange I've been using for over a year and a half now, including all of our members. If you're interested in signing up, trading there, and supporting the channel, you can do so with the link in the description. Thanks for listening. Just to keep everything, in check and everyone on the same page before we get into the macro. Right now, we are on a daily downtrend. The daily downtrend is represented by this downtrending resistance. We'll keep this nice and short because we talk about it a fair bit. For us to become bullish again on the daily chart and thus become bullish on the higher time frame, right? Because for us to become bullish on the higher time frame, the daily, of course, needs to be bullish. It's late. We can't be bullish on the macro, but bearish on the daily and expect the price to go higher and higher and higher. Eventually, it will get weakness and eventually it will retrace. Right now, what we're seeing is a bearish daily chart. This is signifying overall weakness, which has the potential to develop into weekly weakness. At the moment, we are not in a macro bullish trend. A macro bullish trend, as we'll explain later, will originate above $30,000. This has been a fact that we've remained and kept for a very long time, and is basically what the chart is suggesting. There's no interpretation of it. There's an absolute, as per the prior data, as per the 4-year cycle, as per the volume and liquidity zones, as per absolutely everything we've seen on the chart, 30,000 is going to be the key level we need to break above on a monthly chart to become macro bullish. At the moment, we are weekly bullish. However, this is massively weakening, and we'll discuss that in a moment, but we are daily bearish. We're in a weak bearish trend, which is represented by this daily downtrending resistance. For us to become bullish on the daily and thus more bullish on the weekly, and then potentially push into a bullish monthly chart, we need to see 2 things occur. We need to see a daily trend break, meaning the price needs to get above the daily trend, and the RSI needs to flip. Now, this is obviously a very real possibility we'll be watching for a daily flip in trend. This will be a very bullish sign and a very good thing to occur. We'll be watching out for that. Until then, the downtrend is a downtrend is intact, and the possibility to move lower towards these lower supports is still there. So definitely watch out for that. But we're not going to get into it too much today. Today is more of a macro analysis, but I want to give you a quick update on what is happening. Looking at this chart, copy it down, understand it. Right now, everyone who's saying we're in a bear market is wrong. Everyone was saying we're in a bull market. They're also wrong. We're not in a bull market. We'll talk about what we need to see for a bull market. And we're not macro bearish until our lower support of this level is lost. Remember, we're in a weekly uptrend until 24.4 to 25.2K is lost. Okay? We're in a weekly uptrend. We're in a monthly uptrend until $20,000 is lost. Therefore, we can't be weekly bearish if we're still above our weekly uptrend support, which of course is going to be this level. If we're not weekly bearish, how the hell are we macro bearish? It doesn't make sense, okay? You have to use a degree of logic when you're looking at our charts. Obviously, 1 + 1 will always equal 1. We can't just make it equal something that is not, okay? The data is the data, the facts are the facts. We can't alter it based on what we want to see or what internal biases, whether it be a subconscious bias or a conscious bias, that we want to play on the charts. So let's take a look at the macro charts, because that's a chunk of today's video. So the 200 moving average is something I've been looking at for a long time, and it's something I hear a lot about on everywhere, YouTube, Twitter. Not that I watch YouTube, I don't really watch any other creators or traders, because it's just noise in my opinion, but I hear a lot about it from people I know who trade, and the 200 moving average is one of those things that I don't really apply all that much significance to. I don't really care too much about what the average price is over a period of time and what the price is now in comparison to that. What I care about is structural levels. I care about trend strength. I care about liquidity zones. I care about actual solid pieces of metrics of data, such as momentum, volume, volatility, speed, velocity. The things that actually create price strength is what I care about. I don't care too much about where the price is in relation to the average price over a 40-week period. Although it's relevant, although it's important, it's really not going to drive price action. So because we're broken underneath the 200 moving average, it doesn't mean we're going lower. And this is the misconception. People look at the 200-day moving average wrong. They say, oh, we're broken under the 200 moving average, we're going to go lower, we're going all the way down. Or we're broken above the 200 moving average, we're going all the way up, we're going to the moon. No, if it was that easy, the market would be a lot different. But it's not that easy. It's really not that. What the 200-day moving average suggests is it suggests a shift in the strength of the trend. It shifts the strength of the trend because, again, it represents the average price over a 40-week period. So if you're underneath the average price in the 40-week period, that suggests within the last bit of price action, the last range of price action in which we were above it, that area was displaying enough weakness to the point of which the price has broken back below that trigger point. Now, as I said before, we are still very much in a weekly uptrend, but this signifies weakness on the higher time frame. The break of the 200 signifies weakness on the higher time frame. It is not a point of validation, meaning we are going to go lower. It is all it's saying is it's saying we are currently experiencing weakness on the macro. This weakness has now lost the 40-week average price. This could develop into a lower move down. Be cautious and aware of that, and be aware that the weakness has displayed when you're doing your analysis. It's not saying, okay, time to short. That's not what it's saying. It's not saying, okay, time to long when we break above it. Although we can see the price move upwards because, again, when we do break over the average price, it signifies strength, and strengthening price action results in momentum, volatility, liquidity, velocity, and speed being positive, okay? The same going for when we break below it. So it can result in moves down, but the cause of the move down isn't because we broke under the 200 moving average. Just as a cause of us moving up isn't as a result of us breaking over 200. It just so happens to occur, okay? So I don't look at this with significance. I don't look at this and say, oh my God, the 200 moving average is lost. Everyone panic, markets going new lows. I don't look at all that, but I do take it in consideration when looking at the higher time frame trend. What I'd be looking at more importantly than this level is going to be the structural levels, the weekly trend support, the 25.2 to 24.4K level. You can see on the VIPV, very light on the side over here, we have a gap in the VIPV. This gap has actually been filling for the last few weeks as we've been pushing in, but we do still have a large chunk of support. Look where it climbs up. There's almost like a cliff over here that we fall off above 25.2k. We've seen last time we broke above it, we went skyrocketing up. Therefore, this level is going to be a major point of liquidity, a major bouncing point, and a major area of support. We may not even reach it, guys. We may not even reach it. We'll discuss what we need to see for that to occur, but it is there. It is support. So let's take a look at a few more indicators and then get onto the 4-year cycle and then wrap up the video. So I want to quickly end up on the weekly chart with 2 more indicators, and those ones are going to be the RSI and the Gaussian channel. So the Gaussian channel is a really good one, and this is a really powerful tool of predicting macro trends. Right now, this is on the weekly chart, and therefore we're using it for the monthly trend, all right? We're using it for a monthly trend, even though it's on the weekly chart, it's going to reflect monthly direction. So when we're looking at this chart over here, we are looking for our 2 things. Number 1, we're looking for the color of the trend, okay? Number 2, we're looking for the location of the price action in response to or in relation to the channel itself. When the price is above the channel, it is an uptrend. When the price is below the channel, it is a downtrend. When the channel is green, it represents strength. When the channel is red, it represents weakness. We have 2 more points we want to look at. We have break in and we have breaks above. Breaks in and above represent shift in momentum or shift in the strength of the trend. Looking at the price action here, we had a very clear shift in momentum and strength as we approached and broke above $23,000. Awesome. We have failed to get above the upper band. Where does the upper band line up with? $30,000, no coincidence. Therefore, we need to see a weekly break above $30,000 to push us any higher. Now, this may not seem relevant now, but we'll get back to it, and remember that because it will apply relevance in just a moment. Number 2 is going to be the RSI, particularly the 62 on the RSI. If you remember back to our video on the 14th of April, when we sold our Bitcoin. We sold our Bitcoin on the 14th of April, right on the top, literally just over 31,000, right on the pinnacle top. The reason we did that was not only was we identified 30,000 as a major resistance, as a major liquidity zone, but we recognized that the RSI on the weekly chart is showing signs of weakness that could potentially lead to a shift in the momentum, and it has occurred every single time we break below the 62 on the RSI, represented by here, okay, represented by here. I can show you every single example. There has not been one example on the RSI over here in the last 6 or 7 years that when we did not break below the 62 on the RSI on the weekly chart, we didn't result in a crash. Every single instance has resulted in a correction. Every single instance. The reason being, momentum is a leading indicator for price action, okay? Look what happened. We saw that coming, we sold, look at the correction that occurred. We saw a near 20% correction on Bitcoin. Absolutely phenomenal stuff. Keep an eye on the RSI, but equally when we break below it, we go down. When we break back above the 62, we actually go upwards. We can see over here, we broke back above the 62. What happened to the price action? We went upwards. Look over here, we broke back above the 62. What happened to the price action? Okay, we went upwards. We can go back, guys. We can go back. Look what happened here. We broke above the 62. Look what happened to the price action. We went upwards. So momentum is a powerful tool when used correctly. The majority of people do not use the RSI correctly. How we use the RSI is from an unconventional, untraditional way of using it. I look for momentum shifts. I don't let myself look and use it as a description of momentum. I don't look at it and say, what is momentum saying? What is it doing? I look at it from a future tense. I say, what is the momentum doing? How is it adapting? How is it shifting? And what could that shift result in the future? What does that shift mean in momentum? And how could that potentially influence the future price based on our structural levels, based on our liquidity, based on all the other metrics of price action? We can actually predict the future pretty well with that if we look at price action. Now, another thing comes to the question is, when is the bull run starting and are we going to new lows? And sorry, today's a longer video, but it's an essential video that I do want to get out. Is the bull run starting? Are we in a bull run? Were we in a bull run over here? The answer is no. And this is what we need to see for a bull run to start. I'm going to break it down really simply, because just like anything, guys, just like a RSI, just like a rising wedge, just like a whatever kind of pattern you want to describe, whatever cycle you want to describe, there are key points of validation we need to meet. There are key criteria in which we need to actually meet before we can actually say we are in this cycle. We're in a bull run, we are in a pattern that we're describing. There are key criteria. Things don't spontaneously happen. We aren't just in a bull run because the prices go up, just like we aren't just in a bear run every time the price goes down. So for a bull run to start, we need to see a few things. And we can look at it from a few perspectives. Number one, we can look at it from a date range perspective. I've gone ahead and labeled red, bear market, gray, neutral reversal, green, bull market. If we look at the date range trend, we can see the date range trend represents around a 17 bar period from bear market lows to when the bull run starts. If we take that same date range and apply it to the chart, it represents a starting date of around around April 2024, potentially 1 month sooner, March 2024. According to our date range trend, the date range trend does not expect the bull run to start until April to March 2024. Now, I do not expect the 4-year cycle to play out indefinitely. I just want to get that off the top. I do not expect the 4-year cycle to indefinitely play out forever. Eventually, it is going to break, or it's going to be suppressed, or it's going to, whatever's going to happen, I don't expect it. But it is good to look at the data, because even though the 4-year cycle might not play out per the books, the key levels on the charts in reference to prior cycles will be relevant, okay? Price action moves in almost relevant, or I would say, what can I say? The history of price action is very good at predicting the future of price action. Price action moves in similar patterns and similar ways. These patterns cannot be identifiable just because we don't apply these patterns to a broader theory or a cyclical theory. It doesn't mean the patterns are no longer relevant. And that is what I'm trying to get at. So, looking at the next thing. Number two, for us to even look at getting into a bull market, we need to break about 30,000. Obviously, how can we go up into a bull market if we're not going up? But 30,000 is significant. The prior lows of the prior cycles, look at these red lines. Every single time we break a monthly candle above, we end up going upwards to our dotted trend line. Monthly candle above, you know it, dotted trend line. Monthly candle above, you know it, dotted trend line. So what does that signify? It signifies the macro uptrend begins once we break above that horizontal line. But when does the bull run start? Well, so I've given you one point of validation. The second point of validation is we need a monthly candle close above the dotted trend line. The dotted trend line is the high of the dead cat bounce after the bull run top. The high of the dead cat bounce after the bull run top. The high of the dead cat bounce after the bull run top. Breaking above that level enters us into a bull run. You can see monthly candle close above, we are in that bull run territory. Monthly candle close above, we are in the bull run territory. And finally, we need to see a monthly candle close above the baseline of the Ichimoku cloud. Right over here, right over here. Coincidentally, or maybe even non-coincidentally, this has occurred on the same date range trend as per the 4-year cycle in the last 2 instances. Maybe a coincidence, it's only 2 times, maybe it's not a coincidence, maybe it will happen again. Keep your eyes out for that. Now, how do we know that a bull run starts at that point? Well, we have to define what a bull run is. We have to understand what a bull run is. A bull run is a sudden, extended surge in liquidity, volume, and volatility in a particular market. How can we define what that is? How can we actually explain that? We can use trend angles. If we take the angle from the bottom to that dotted trend line, the bottom to the dotted trend line, okay, the bottom to our hypothetical dotted trend line and our date range, we can see an angle of around 40 to 35%, okay? If we take our dotted trend line to a bull run top, however, we can see the angle significantly increases from about 35 to anywhere between, and we don't know where it's going to go, we can assume that it's going to go upwards, right? Anywhere between 35 to 50 in that scenario. In the prior scenario, 40 to 61. That shift in trend angle, the steepness in the trend, signifies more volume, more liquidity, more momentum, more velocity. Therefore, a bull run. That is what we're looking for. So how can the bull run be declined? What would we need to see for the bull run to break? 2 things. Number 1, we need to see the current validations broken. Meaning, firstly, according to the 4-year cycle, we need to see the date range trend be lost. According to the date range trend, the bottom was here. Therefore, for the 4-year cycle to be broken, we need to see a new low print. How can we see a new low print? Well, we need to lose the macro support, which is $20,000. Now, things don't happen randomly. Price is driven by economic data, political decisions, and social perspective. So what would drive the price below 20,000 and potentially drive the price to a new low, which could break the 4-year cycle as we know it? Now, just because the 4-year cycle breaks, It doesn't mean everything else we discussed is invalid. All that is completely valid. It just extends, drags out, slows down the cycle. It deletes the cycle and potentially delays the next bull run, or it shifts the date range trend that we have at the moment. It doesn't ignore the current levels. All it does is completely eradicate or decimate the current trend we have at identifying certain date levels or date or points of price action on certain times on the higher time frame. So what would have to happen? It's very simple, guys. It is very simple. And to understand that, we need to understand how the cost of debt influences investors' decisions. More importantly, how the cost of debt influences companies' ability and, should I say, risk tolerance in acquiring risk assets on debt. And if we look at that, we have to look at interest rates. So if interest rates start to go back up, if we get a second wave of interest rates, we are likely to push the price lower. If interest rates go up, the cost of debt rises. The cost of debt rises, the repayments or the debt to service ratio starts to go up for individuals and for companies. Companies and individuals have debt obligations, whether it be a home loan for an individual, a car loan for an individual, a personal loan for an individual. That requires more money. Now, if you're spending more money on that, you have less available household cash flow to invest in. You're more likely to sell off your assets to fund those short-term or long-term debt services for whatever purposes, okay? For a company, it's different. If a company is acquiring risk assets for the purpose of generating income, and the income is now either worth less because inflation is rising, or their balance sheets are decreasing in cash flows because they're making less sales because the cost of debt is rising and the cost of goods are rising, or of various other reasons, such as the risk of the market is increasing because interest rates are rising and systematic risk is increasing, they're more likely to sell off those risk assets to increase their books cash flow to make their company look more appealing and make it look healthier in a situation where the stock price is generally not looking healthy in an attempt to keep the stock price high. Additionally, they're less likely to take on debt to acquire assets, as the income to debt repayment ratio from the actual income producing asset they're acquiring is going to be lower, and therefore the risk of acquiring that asset is going to be higher and potentially more unfavorable for the company. Anyway, I'm not going to get into it. I can go on for hours about this kind of stuff, guys. As you know, I have a background in economics and business, but I'm going to leave it there. I hope you enjoyed today's video. If you've got any questions, leave them down below. It's going to be a very interesting week, guys. CPI, FOMC, interest rates. My best advice for everyone trading is to take it easy. Don't chase the market. Don't feel pressured to trade news events. I don't even trade news events. I literally don't even trade it. If I do trade it, I put money in, but I'm totally happy with going to the casino. If that's how I look at it. If I'm trading news events, you're up against big whales. You're up against people from the government. You're up against insider traders, manipulating people who've got that information before you. Remember, trading is PvP. You're up against other people. You are trading against me. I'm trading against you. But at the same time, in these news events, we're trading against people together who know what's going to happen with the data already. They can position themselves effectively. More, however, they can manipulate the price action in preparation for their certain positions to play out and trap or fool people into positions to provide liquidity. So thanks for watching. See you guys tomorrow. Hope you enjoyed. Cheers.